Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets.
Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, we're going to discuss the Bank of Canada's interest rate decision. We'll touch on what they did, our view as to why, and what we might expect going forward. So let's get right into it. On Wednesday, June 4th, the Bank of Canada maintained its target for the overnight rate at 2.75%, marking the second consecutive hold after 7 rate cuts totaling 225 basis points since June of last year. The decision reflects a cautious approach amid economic uncertainties, particularly due to U.S. trade policies and tariffs. But unlike in the April monetary policy statement, when the word uncertainty appeared 11 times, this month it only appeared 4 times. One should not read too much into this, but I thought it was kind of cool and worth sharing and reflects the less pointed fear of the unknown. The BOC also noted that Canada's economy entered 2025 strongly, but faces challenges from trade conflicts, which could slow growth and increase inflationary pressures. This no change, or no cut, was to be expected. We know this because of the probabilities implied by the overnight index swap curve, which in simple terms allows market participants to bet on the direction of short-term interest rates. You can see this on the table indicating the probabilities of different outcomes and the dots that represent the expected future path of the Bank of Canada's short-term policy rate. Despite my Loonie Hour Twinkie bet to the contrary, no one should have been surprised by the bank's decision. As always, during the press conference that accompanies most of the rate decisions, there were a couple of interesting takeaways. One was the confirmation that cutting the carbon tax had a clear impact on inflation. We knew this because the data and the charts from the CPI release from a couple of weeks ago, but it's nice to get the confirmation from the Grand Poobah, the Bank of Canada Governor Tiff Macklem. The next thing is that the Bank of Canada is looking through Q1 GDP data. Politicians from the ruling government were quick to brag about the decent Q1 GDP growth numbers, which came in at 2.2% annualized, which was slightly stronger than the bank had forecasted. But the composition of GDP growth betrayed that it was really due to pulling forward trade with the U.S. and inventory accumulation, which boosted activity. With final demand roughly flat, there's just too much trade uncertainty to read into these figures. Another interesting tidbit was challenging the very popular jingoistic anti-U.S. trade sentiment. The governor made it very clear, and I quote, "Canada's trade will always be concentrated with the U.S. I mean, just look at a map." He went on to plead for improved east-west transportation without expressly saying pipelines, and that Canada should look to new markets. But when you hear politicians say our trade relationship with the U.S. is, quote, over, know that this is total BS, and you should ignore that rhetoric. Proximity and pipelines matter. Of course, not everybody was happy with the Bank of Canada remaining on hold. Some people, in fact, made the case that not cutting short-term interest rates by 25 basis points was a massive mistake. Although we are very sympathetic to Mario and others who would hold this view, and we think it comes from a good place, we also think it's misguided for a couple of important reasons. First, I will concede that Canada's economy is hurting. Top-line growth has been propped up by the insane immigration policy that continues, suggesting that Canada has been in a per capita recession for a couple of years now. The unemployment rate is rising and very well likely to continue to do so. Business and consumer sentiment is poor, and Canada remains mired in a productivity emergency. However, the BOC is a single mandate central bank. Unlike in the U.S., where the Fed may focus on full employment, the Bank of Canada's primary objective is to maintain low and stable inflation, targeting a 2% midpoint with a 1 to 3% inflation control range. Its broader goal, as outlined in the Bank of Canada Act, is to promote the economic and financial welfare of Canada by regulating credit and currency, controlling monetary policy, and fostering financial stability. This limited mandate may seem harsh, but there are always trade-offs. And there is a huge risk, especially in Canada, that a full employment mandate will be politicized. In short, the Bank of Canada cannot solve everyone's problem all of the time. The next thing to note, and this is with respect to the housing market, is that cutting short-term interest rates may not lower mortgage rates at all. In fact, some BOC rate cuts coincide with rising mortgage rates, as they are priced off a different part of the yield curve, a part that includes a term premium, inflation, growth, and of course, credit risk. Canadians clamoring for more rate cuts should be careful of what they wish for. A practical counter-argument to more rate cuts is that inflation is actually rising again. We know this because of the Bank of Canada's 3 preferred measures of core inflation that are currently tracking higher, the blue lines on this chart, 2 of which are above the inflation control range. And remember, these measures are not as fickle as headline or even the regular core inflation measures. What we've seen is a meaningful inflection point, and that should give us pause. And indeed, I think it gave the BOC pause. Finally, a philosophical argument as to why the BOC should not cut rates at all, and indeed might even think to raise them. In my view, persistent negative real interest rates are a disaster. This is when short-term rates are kept below the rate of inflation, in effect, making short-term borrowing free in real terms. In my view, it's where monetary policy in Canada went wrong circa 2010. It fueled a housing bubble, it siphoned away capital away from non-residential capital investment, and contributed to the productivity emergency we're still dealing with today. In my view, it screws over savers in favor of borrowers, and more importantly, the working class in favor of asset holders. It's my hope going forward that the BOC resists the urge to lower interest rates below inflation again. All right, that's a wrap on this week's episode. Thanks again for watching. Please like, subscribe, and follow for more. As always, we manage money for families all across Canada and the world, so feel free to get in touch.